And a very warm welcome to you all. Thank you for joining me on this channel. And we're starting this YouTube channel with the goals of providing quick daily updates of financial markets. Most of our videos are going to be 3 to 4 minutes in length. That's about it. And then we're going to be putting the financial and real estate markets into a broader perspective using a Federal Reserve policy, the current interest rate rising cycle as a framework, and then over the longer term being able to establish a daily chronology of this Federal Reserve tightening cycle, and then beyond once we get past this tightening cycle, and then provide timely updates of very specific real estate stories. And we start off, the starting gun goes off on November 3rd, 2021, as the Federal Reserve Open Market Committee released the official statement of reducing quantitative easing, and that reduction will go through March, as we've seen, and then following QE, the QE reductions, then we start seeing the interest rate rise, which we started seeing again in March. And we can see the reduction over the course of time, going from the October-November 2021 period to current at the purchase desk at the Federal Reserve Bank of New York, and how that's gone from 106.9 billion in the October-November 2021 period down to $38 billion today. And that should be about where it settles in. A reinvestment purchase operations of approximately $38 billion per month. And next we can see the dot plot coming regarding Fed funds rates coming from the most recent FOMC meeting. And we see the current dot plot at 0.5%. And in 2022, they expect those rates to rise to 1.75% in 2022 and then rise to 2.25% in 2023. That's the current mean estimate. And if we take a look at the underlying economic assumptions coming from the Fed, we can see that the change in real GDP has gone down. That estimate has gone down from a December estimate of 4.0% GDP growth down to 2.8% in the most recent period, and also increases in inflation. The December projection showing at 2.6%, and the most recent March projection coming in at 4.3%. And quite frankly, that's probably on the low side. We're going to continue to see those estimates rise. You can go look over to the right and see the most recent Federal Reserve Bank of Dallas numbers coming in for PCE inflation, coming in much hotter than the current Fed estimate. So Dallas Fed is looking at 7.1% PCE. We're probably going to continue to see the overall Fed, the Fed's overall estimates for inflation continuing to rise, at least for the next couple meetings moving forward. And moving on to the GDP Now estimate, this is just a general overview. Basically, the gist of this is that the GDP Nowcast it's not an official forecast of the Atlanta Fed. It's best viewed as a running estimate of real GDP growth for the current quarter, and it's based on the most recent available economic data, and it's updated quite regularly. As we can see, the most recent estimate calls for 0.9% growth. This is as of March 24th. So we're getting to the end of the quarter, and it looks like we're going to come in at approximately 1%, possibly a little lower GDP growth. It does appear that the economy is slowing down. And here we have a summary since November 8th. We chose November 8th as a start date because that is the first day of implementation coming from the November 3rd FOMC meeting. So starting from November 8th, we can see slight decreases as of today, March 28th, slight decreases in the S&P 500 and the Dow Jones Industrial Average, but we've seen some significant increases in interest rates. Starting at the shortest end of the yield curve, the 3-month LIBOR has gone from 0.145% up to 0.98%. That's a 577% increase in interest rates, albeit from a very, very low base. But we've seen similar rises in the 2-year Treasury, currently at 2.32%, and the 5-year Treasury yield has gone from 1.12% up to currently at 2.56% at the close of trading today. Interesting things to note, we do have a yield curve inversion between the 5-year Treasury note and the 10-year Treasury note. And we have basically a flat yield curve between the 5-year Treasuries and the 30-year Treasuries. And if we look at the 2s over the 10s, the 2-year Treasuries compared to the 10-year Treasury, it's a very slender 0.15% yield curve, very, very flat. And I would expect that to invert quite soon. Moving on to the 15-year mortgage, to both the 15 and 30-year mortgage numbers, we're looking from November 8th at 2.77% on the 15-year, moving all the way up to 4.23% today, and then the 30-year mortgage going from 3.2% all the way up to 4.95% as of the close today. The 30-year, the mortgage rates are courtesy of Mortgage Daily News. And you can see here the 3-month LIBOR, the increase in rates noted on the previous summary page. You can see the 2-year Treasury yield closing at 2.328%. The 5-year Treasury yield shooting up. The 10, here's a longer term chart of the 10-year Treasury yield. You can go back and at the far, on the left-hand side, you can see the COVID low in March of 2020. And interesting on the next chart, I'll move forward to that. We're currently at approximately 2.5% on the 10-year Treasury yield. And you can see here, we did a projection for clients back in September of 2021, and we were projecting a reasonable target of 2.49%, and which is what we hit today. So that's why I bring that up. And what that basically means is this was an initial target that we had targeted. We're going to recalibrate that target for a higher rate, and we'll be coming out with that in the next few days. The 10-year Treasury yield today, the 10-year Treasury, this is a 3-month chart, 3-month hourly chart. So you can see that we backed off a bit. It does look like if you look at the rate of change, this is the 14-hour RSI at the top. It does look like we're poised to go even higher in the short term. And looking at the 30-year Treasury yield, again, you can see on the left the March 2020 lows, the spike lows with COVID, and how we've gone to new highs since. And then finally taking a look from the Mortgage News Daily, 30-year fixed rate mortgage at 4.95%, and the 15-year mortgage rate at 4.23%. And that's having a predictable impact on mortgage applications. This chart is as of today, it's as of last Thursday when they report the mortgage applications. Having said that, we're probably going to continue to see even lower lows in mortgage applications because rates continue to spike higher. So it's something to keep an eye on. And this coming from Calculated Risk blog, we can see that the housing inventory issues seem to have bottomed, and we're going to begin to see inventory increasing over the coming months, which is typical. We normally see lows in inventory in the wintertime and then increasing in the spring. And you can see the little chart here at the bottom. The year-over-year change in inventories is slowing. And so we should see some improvement in inventory issues in the real estate market. Quick look at the dollar index. You can see the strength in the dollar. And moving on to the equities index, Dow Jones and S&P is coming up 1 year. One thing to note is we do see a downtrend that has been established in the Dow Jones Industrial Average since the beginning of the year. So that's going to be something to note to see if we can, if that's going to continue. And we really are at an inflection point right now, a potential inflection point. So let's see if we continue to see the short squeeze that we've had over the last 2 weeks, if that continues, or if we're close to the end of that. That will be one of the more interesting points to find in the next, I'd say, 2 weeks to keep an eye on. And we take a look at the S&P chart. One thing to note, if you go back to looking at the Dow Jones Industrial Average, that has seen a series of lower lows, whereas the S&P has come up and is challenging the previous peak, which would tend to indicate that we're at a point where either the markets turn down in the next 2 days, basically immediately, or we break to a shorter term high beyond the January highs. And here we are on the 3-month S&P hourly chart. Again, the next 2 days are going to be really quite interesting, and we'll see if we're at an inflection point right now. It does appear that we're overbought, looking at the 14-hour RSI. So is it possible that we have seen a high in the short term in these markets? And the implication would be that we do go to lower lows. So the next day or two are going to be quite critical.